David Bahnsen with us this morning. Right, you say the market's in the early stages of a long overdue rotation. Okay, so how do I invest in it?
Well, I think that you've already seen this start 4, 5, 6 weeks ago, where a lot of the things that have been most popular for a couple of years with AI have been coming down, in some cases a lot. I think that what has really picked up is healthcare, which had been one of the worst performing sectors of the year. Consumer staples are due. Energy is due. It's still down. I don't think you're going to see a bear market right now. I think you're going to see a rotation where leadership in the market changes, and I think we're in early innings of that.
You've often said that valuations on tech stocks are just way too high. So is it a bubble, and is it now popping?
Yeah, I think that it's a severe bubble for some of those AI things. That you look at like a Coreweave, which we've talked about on the show, it's already down 75%. I'd say that's a pop. Oracle, has given up such a massive amount of its return. Other names that are big tech, that are less AI, that have big businesses, I don't know I'd use the word bubble, but they're frothy, they're expensive. You get lower returns in the future when you buy at a higher valuation.
So I'm not going to be buying any more big tech? Hoping for a rebound?
Stuart, I can't speak for what you're going to be buying. I can tell you what I'd advise you to not buy. I'd hold a lot of your good big tech names. You have big gains in yours. You don't want to pay those capital gain taxes. But I think that that right now there's some good opportunity. And you're going to be shocked to hear me say that a lot of it's in dividend growth names.
Oh, I'm shocked. Shocked indeed. And I'm sure you'll present it with the dividend-paying stocks a bit later in the show.
If that's what you want, that's what I'm going to do.
All right, David. 4.6% unemployment. What does that tell you?
Well, look, I agree that I want a higher labor participation force, and that's one of the things that I've been most distressed about for 15 plus years. More people leaving the labor force, that does push the unemployment rate higher. And if she's right that it's going to lead to more people getting jobs, that can be fine. The problem is when they talk about the new private sector jobs being created, they're not talking about the layoffs. The net number is very, very small. We've had 1.7 million layoffs in the private sector, according to Challenger Great Christmas. So there's not great labor data out there. 64,000 was not a great report. We were at 250,000 jobs a month a year ago. So there's a lot of work to do here.
David, we have just enough time before the bell rings to open the market for you to give us the lowdown on one of your dividend stock picks, which is Vail Resorts.
Yeah, we just recently added this to the dividend growth portfolio, and it has a 6% dividend yield. Stock is down quite a bit. We did a ton of research here, really like how they've stabilized their revenue stream with this epic pass. So they have, first-class ski resorts all over the world. They have a pass that gives them revenue even when it's a bad snow season. So far, it hasn't been a great snow season. Stock has been down a lot. We came in and bought it on a 50% dip. We had lucky timing. We bought it at a great price, but a 6% dividend yield paid from cash flow, and we think that this has got a lot of room to go into the future, Stuart.
I want to deal with a stock that was highly recommended on this program and heavily poo-pooed by none other than David right here, and that is Coreweave.
I have this natural instinct of believing in the private sector being the private sector and the governmental sector being the governmental sector. So when we talk about the idea of this being a good thing for a company that the government wants to come in and own stuff, forgive me that I forgot I'm not in North Korea.
That's a little dramatic.
Okay, that's a little dramatic. Coreweave, by the way, is a phenomenal company. They lose $2 to $3 billion a year, but my point is never about the company, it's about the stock price. That when they were at that $150 level, the valuations are extraordinary. Right now, they traded at a negative 29 times PE. That's a lot better than when they were trading at a negative 70 times PE.
But even in your private life, away from your dividend company, you wouldn't touch that with a 10-foot pole.
No, but that's just because I do believe that public companies, you want to be buying future discounted cash flows, and you can't do that with something like this. It's more speculative, but it could go all over the place. It's just going to be a trading stock, not a long-term ownership stock.
Nike, they're down this morning. China weakness is a big story, I think. What do you say?
Yeah, we don't own it, but I've looked at it for years. We'd like to get there, but these consumer discretionary names are tough for dividend growth investors because they're so cyclical up and down. The China story is a problem, and the tariffs.
Let's move on to FedEx. Any comment?
I also just think that there might be a lack of pricing power. It's expensive to use FedEx now, and they've really had great pricing power to push their margins higher, but they may just have a tough time expanding that from here. We owned the stock for a while. We made great money on it. It was a good dividend grower, but we sold it some time ago. It hasn't done much since we sold it.
DraftKings. Well, I don't understand this. DraftKings is getting in on the prediction market.
It's really getting hard to know the difference between prediction and bets. And so it's got different regulators depending on what you call it. So DraftKings is coming into the prediction markets, but they've already been in the sports betting, where Kalshi and Polymar got into the sports thing by calling it prediction. So it's just kind of confusing to me.
And now you have Robinhood and Coinbase.
Yeah.
What we know is that there's a big ecosystem of people all making money off of folks gambling.
David, we've just got time for your last dividend pick of the day, and I believe it is Brookfield Infrastructure.
Yes, BIPC, you have so much talk on data center right now, but you don't want to be all in on data center. This is more diversified. You have data center in there, but utilities, transportation, gas, just kind of a play on infrastructure with high dividend yield. They've grown at 6% per year. Brookfield, of course, is a wonderful asset manager. We love it.
Hey, David, thanks for being with us for the hour. We appreciate it. And Merry Christmas.
Merry Christmas, my friend.
Thank you, sir.